The majority of stocks in the S&P 500 are trading at incredibly high valuations when we look at it on a PE basis. We have companies like Eli Lilly at 142, we have Nvidia at 76, Broadcom at 73, and as we can see right across the board, there aren't that many companies that are looking at fairly good valuations. And when we take a look at the S&P 500's historical performance, in terms of the PE ratio, the mean and median do sit around 15 to 16. Currently, right now, we do sit around 29.34, meaning that we are expecting over the shorter term a pullback. Whether or not it is a full-on market crash or a dip, it is something to consider. And in today's episode, we want to focus on companies that are resistant to these drops, whether it's a recession or whether it is a small drop. Now, what we mean by this is we want to take a look and see how well they've performed in the last recession. Remember the Great Recession of 07-09, where the S&P itself did fall down by around 55%. Now, the first company we are looking at, now bear in mind as well, not all of these will be looking incredibly undervalued, which is why we are going to talk about our own price targets. But the first one is essentially Walmart. It has the best recession return of what we are about to cover today, positive at 7%. As we mentioned, the S&P, as we mentioned, negative 55% return from this period, and they also increased their dividend during the last recession, and they had pretty much above average growth, 0.1%, when the S&P itself was around negative 12. Now, when we take a look at this company as a whole, over the last 12 months, it is up around 34%. And over the last 10 years, if you have been a shareholder, well, you would have essentially outperformed the S&P, up 172%. Bear in mind, if you reinvest dividends, you would be up marginally higher. We can see right now it is trading pretty much towards its 52-week highs, with Wall Street giving this a very good buy rating, 4.4 out of 5, although we do see the other analysts give it a hold. In terms of the yield, well, it sits at 1.2%, and in terms of a forward P, it does sit around 28 currently. Now, in terms of the dividend safety, it does get a very nice score, 90 in fact, making it very safe. And we also note something very attractive with this company, a nice dividend increase in February this year, 9.2%, well above the minimum we look for on this channel of 4%, just to keep up in line with inflation. Now, when we talk about this company, in terms of the valuation, and just one thing to bear in mind, on this channel we do a lot of deep dives. We go through every single one of these models, and we go through them in quite some detail. Today's episode, we're just taking a look at the intrinsic value. For Walmart, we get to $74. Now, that isn't too dissimilar from Wall Street's target of $75, where they see 9% upside. Now, bear in mind, this is one of the best recession-proof stocks that you could have in your portfolio, but always great to get it at a nice margin of safety. So at 10% MOS, it would be a buy at around $67, which is a few dollars shy of the current trading price. Remember, we execute on this 10% level if we believe it has some strong financial metrics, a wide moat, and good forward-looking data. Now, if you're looking for a larger margin of safety, which would be reasonable, 15% around $63, and at 20%, if you can get this company around that $59, $60, then it is definitely a great one to consider, especially if you do see a recession happening in the near to short term. The next recession-proof stock that we have here is McDonald's, and a negative 3% recession return, again significantly better than the S&P. They also increased their dividend during the 07-09 recession. They also had above average growth, and they're only 3 years away themselves from becoming a dividend king. Now, in terms of this company, we do get a double buy rating, unlike Walmart with a hold from Quant. They are trading in the mid to lower end of the 52-week range. In fact, I did recently add more of this company to the portfolio. Do check out that deep dive if you want to see. In terms of the forward yield, well, 2.63%. In terms of the forward PE, we see it just below 21. Now, in terms of the last 12 months, they are down around 14%. Over the last 10 years, though, similar to Walmart, you would have outperformed the S&P 500. When we talk about this dividend safety, well, a 77 safe score, and we can clearly see a very nice increase to their dividend, 9.9% in October last year. Now, when we talk about the valuation, as I mentioned, it was one that I did add earlier on over the last few weeks. $293 as the intrinsic value. With that current price, we do see a nice margin of safety. 10% will buy at $263, 15% around $249, and again, for those that are looking for a 20% MOS, you would need to see around $234. So in today's episode, you are getting somewhere between a 10 to 15% at that current trading price. Now, in terms of Wall Street, what they see around 21% upside, their price target at $309 is higher than our intrinsic value. So again, this is definitely one they consider you should buy. Also, the added bonus that it does, based on historical performance, look to be recession resistant. We then move on to General Mills GIS. Now, recession return -12. Again, very strong, significantly outperformed. Not only did they increase the dividend, as well as having above average growth recession sales, but they've been paying a dividend for the last 126 years without a reduction. Phenomenal, not something you see from many companies these days. In terms of the ratings, well, we get one buy rating from Seeking Alpha with a double hold from the other two analysts. It is trading right there towards its 52-week lows, and it does have a nice forward yield, 3.81%, with a forward P sitting at just above 14. Over the last year, well, down 16%. Over the last 10 years, they are up around 19%. Pretty poor in terms of any investment over that period. And we do see all-time highs sitting around that $90 mark a year ago today. In terms of the dividend safety, well, we have a very safe score of 90. Always great to see. But we do want to point out they did increase their dividend just last month. Very trivial, 1.7%. Not something we really want to see. As we mentioned, we ideally want to see above the inflationary rate. In terms of the valuation, well, $72.53 our intrinsic value. Remember, you can grab a copy of this model by clicking on the pinned comment below, running your own numbers through. Margin of safety then at that 10% level, it is a buy right now if that is sufficient. At 15%, it isn't quite there yet, so sitting somewhere between the 10 to 15%. And again, those who are looking at 20%, you would have to wait for around $58. In terms of Wall Street, 13% upside, their price target not too dissimilar from our intrinsic value. And as always, do let us know your thoughts in the comments as we go along today. Now, before we move to the next stock, just to let you know, we have released our latest free weekly article, 18 Undervalued Dividend Kings. And with this article, you do get a free spreadsheet with all of the Dividend Kings and our buy ratings. If you want access to this or any other articles, it is all completely free. Just click on that pinned comment below to sign up. And we are releasing another free article on Monday. The next stock we are looking at is Old Dominion Freight, and we can see -22%. Again, a significant outperformer during the last recession. In terms of ratings, well, we get one buy rating from Seeking Alpha with a double hold. It is trading in the mid to lower end of the 52-week range, and we do see a lower yield than the others so far at 0.55%, and a forward P that does sit a lot richer as well. In terms of performance, well, over the last 12 months, it is up 1%. Over the last 10 years, significant outperformer of the S&P, up 823%. And when we have done our deep dive on ODFL, this is an incredibly high quality company. In terms of dividend safety, well, 81 score, it is very safe. When we take a quick look at dividend yield theory here, we can see it has offered one of the highest yields over the last 5 years, so that is a severe undervaluation signal. And they did increase their dividend in January this year, 30%. That is very high, and something we all love to see as dividend growth investors. In terms of the intrinsic value, well, $205, which does indicate an MOS at 10%, isn't quite there yet. You'd have to wait for $185. Given again, this is a high quality, maybe you are happy with a 15% MOS, and that would sit around $175. In terms of Wall Street, well, their target price of $209 does indicate right now 10% upside, but as always, it will come down to your investment strategy and what margin of safety you are looking for, depending on how you see the companies, high quality or not. We then move on to Abbott Laboratories, ABT, very nice recession return, -13%. They also increased their dividend during the last recession, above average growth, pretty significantly as well, and have also been paying a dividend for the last 100 years without a reduction. Now we get a double buy rating, that hold from Quant, trading towards the mid to lower end of the 52-week range, forward yield 2.11%, and a forward P at 22.5. Over the last year, well, pretty poor, -2.5%. Over the last 10 years, again, another outperformer of the S&P. In terms of dividend safety, 90, very safe score. Again, dividend yield theory showing an undervaluation signal, and also nice to note a very strong high single-digit increase in December 2023. When we talk about the valuation, an intrinsic value of 129, not dissimilar from Wall Street, who see 23% upside over the next year. And when we do take a look at the margin of safety, 10% would indicate a buy at 116. At that 20% level, again under $1 shy, so we could say with our estimates and judgments, 20% margin of safety and 23% upside. Again, another strong consideration for the portfolio, and nice to note it is recession resistant based on the historical performance. We then move on to UGI, where we have negative 16%. It did have around average growth, and it has increased the dividend over the 07-09 recession, and on top of that, another company that has been paying a dividend for 139 years without a reduction, things you do really love to see. Then we look at the double buy rating with the hold from quant. Again, mid to lower end of the 52-week range. Very nice forward yield, probably the highest we will look at today at 6.4%, and a forward P that is just under 8. Over the last year, well, not too great, negative 13%. Over the last 10 years as well, negative 31%. All-time highs, again, you would have to go back nearly 6 years ago at $59. And currently it is trading pretty much around half of that today. When we take a look, dividend safety score 60, borderline safe, something to consider. And again, we can see one of the highest yields they have offered over the last 5 years. And we are still waiting for that dividend increase. They haven't yet announced that. So in terms of looking at UGI and the intrinsic value, $35, so we do believe it is strongly undervalued in today's episode, and the MOS level at 10% would clearly indicate a buy at $32, 20% around 28, and when we take a look at that 30% level, you can see in today's episode that is what you are achieving. And Wall Street, again, nice upside, 24%, $29. It will always depend, again, whether or not you do see this as a strong company over the longer term. We then move on to MasterCard. Again, very strong performances in the last recession, negative 12%. However, they did maintain the dividend. They didn't increase it, but they also didn't cut it. They had above average growth at plus 2.1%. And when we take a look, we do get that double buy rating, the hold from quant. It is trading now in the midpoint of the 52-week range with a yield around 0.6% and a forward PE just below 31. Over the last 12 months, well, they are up around 10%. Over the last 10 years, similar to the majority of companies in today's episode, a significant outperformer of the S&P. When we take a look at the dividend safety, well, highest score obtainable, 99, and we can also see something that is incredibly consistent with MasterCard, double-digit increases to their dividend on a very, very consistent basis. In terms of the valuation, well, $531, and with a margin of safety of 10%, which a lot of people will be happy buying for this company, which does really look like a very high-quality company when we've done our deep dives, a buy at 478. At 15%, well, that would be sitting around 451, indicating, again, it could look like a very good buy to dollar cost average in now, and at 20%, you would have to wait for 424. In terms of Wall Street, as we said, they do believe this to be a buy, upside of 19% with their price target of $525. This then brings us on to automatic data processing, negative 29% with the S&P's negative 55. They increased their dividend during the last recession, above average growth, and they are now officially 1 year away from being given that very nice status of dividend king. We only get one buy rating. Interestingly, it's typically either a double buy from seeking out from Wall Street and a hold from quant. Now we get the opposite. We get a buy from quant and a hold from the other two analysts. It is trading in the midpoint of the 52-week range. Nice forward yield of 2.35%, forward P of 26, and over the last year, not the greatest. It is up around 6%. Over the last 10 years, again, outperformer of the S&P. When we look at the dividend safety, well, 97, very safe, and we can also clearly see a nice double-digit increase to the dividend last year, and again, undervaluation on that dividend yield theory. However, when we do take a look at the price, we can see Wall Street are forecasting 10% upside at 262, and when we do use our 10% margin of safety, it is indicating a buy now. In terms of 15%, you would have to wait for 230, and at that 20% level at 217. So in today's episode, ultimately between 10 to 15%. As always though, do let us know your thoughts about these stocks in today's episode, whether or not you have any recession-proof companies within your own portfolio, whether these are on your watch list, or maybe you have already started adding. As always, if you enjoyed today's episode, smash that like button, hit that subscribe and bell button, and as always, we'll see you all on the next one.